You know what's the cost of trading too big? Well, Tastytrade did a study where they basically backtested from 2008 or so to until now, and they looked at the drawdown that you would have had if you were actually trading too big. And I thought that that would be great to react to that study because there's a ton of gem and there's a ton of valuable information that we can take out of that study. So without waiting, let's get into it.
Research team is also really strong, a little bit different direction. The risk of getting big, Bat.
All right.
What we've asked the team, what?
Getting swole.
Yeah. What we asked the team to do was to go out and say basically, all right, so if we give you an opportunity to look back at the worst times in the last 2 decades, 2008, 2009, and 2020. Okay, those are the 2 biggest sell-offs we've had since 2000 was pretty big too on a percentage basis over multiple years, but it wasn't nearly as violent. 2008, 2009 was pretty violent, and 2020 was pretty violent.
Yeah, and there was also 2018 where in February we have seen a big down move all of a sudden. I think it was in like February 2018, but for sure that 2008 and 2020 were by far the most violent move that we experienced like for a long time. I mean, honestly, 2020 will be staying, in the records in terms of bad movements, or one of the worst movements that we ever had.
If we went back and looked at how big an impact getting big as opposed to staying small has, you would be surprised. Once a decade, it's usually about once a decade. It happened once in the 80s. It happened really once in the 90s towards like 1999 stuff. It happened once in the 2000s, and it happened once in the 2020s. There are situations once a decade or so that come up where there's an outlier move that can really put you in trouble.
And what's quite crazy about this type of moves where, for example, Tom says that it happens once a decade, even if you've been like, let's say, trading profitably and you've been generating some great returns for like, let's say, most of the time, you just only need once to actually wipe you out. And that's a bit the crazy thing when it comes to trading or trading options in general. It really doesn't matter how you're doing when everything is going fine. It's more that when everything is going wrong, when there is a big crash and everything, how is your portfolio doing? Are you actually able to survive that down move? That's where it really, really shows if your strategy is actually good. And as I always say, honestly, you can come back from any mistake that you can do. You can do plenty of mistakes. You can, for example, sell a call instead of buying a call, like buy a put instead of selling a put. You can do plenty of mistakes, whatever it is, but you cannot come back from trading too big. And personally, I've come to realize that trading too big is probably the only mistake that will cost you like more than anything.
And of course, everything we do is designed to keep us out of that kind of trouble. That's the whole trade small, trade often, diversify strategy, diversify the underlyings, everything else. And it didn't matter in 2008. If you think because you were short a strangle in the spiders, that was what's going to take you down, I don't care what stock you were long, you lost 80% of your account just being long stock.
Right.
That's something that I really want to emphasize. Usually people are like, yeah, but options are too risky. This is a leverage product. You shouldn't use them. Well, during a crash, for example, like 2008 or 2020, who is not in a bad situation? And of course, there are some degrees to being in a bad situation, meaning that if you are like over-allocating yourself, over-allocating your capital, you obviously are going to suffer more. But someone who would just buy stocks like normally, like for example, let's say that you use leverage to buy index funds, for example, well, you're going to be in trouble too. So it's more like how bad you're in trouble and how can you actually diversify your strategy so you're not too much in a drawdown when things go south, rather than our options are actually a risky product.
So one of the pitfalls of newbie option traders, but it's not even newbie option traders, it's kind of everybody, is the misunderstanding of position and portfolio exposure to market risk. So today we're going to trade option portfolios in a simulated environment that resembles the 2008 and the 2020 moves in 2 key aspects: the high implied volatility and the higher expectation for outlier losses. Okay, we're looking at worst case, once a decade stuff. All right, let's go to the next slide. So it's a heavy study. So we analyzed the volatility and outlier price movement of conditions in the SPY from July of 2007 to July of 2009, worst case. Then we analyzed the win rates and losses in 16 delta SPY strangles sold 45 days to expiration and managed at 21 days over the same period. We conducted a Monte Carlo simulation using the win rates, outlier losses, and average P&L observed over the 2-year period to determine the probability of a 50, 60, 70, or 80% drawdown in an account that traded 1,000 times in that environment. So we're going the full Monty here. The total buying power allocation was either 20 or 30% of net lit. So we didn't do a huge number. We did very conservative.
So as much as I think that this study is very, very interesting, because we're going to be able to see, as they say, what is the probability if you were, for example, trading at like 20% or 30% buying power allocated. However, only trading short strangles is probably one of the riskiest things that you can do for yourself, especially if you're allocating like 20%, 30%, compared to someone who, for example, have a portfolio of long and short positions. Let's say that you allocate 20% of your capital to a portfolio, half of them were for long positions, half of them are for short positions. Well, if there is a crash, your short positions are not going to be in a huge loss. Compared to selling a short strangle, you're going to be exposed on both sides of the market. All of this to say that this study is really like the worst of the worst. I mean, if you're only trading short strangles and you're allocating like 20%, 30%, that's really already a lot just for short strangles where you're only exposed on the long side. So that's going to be quite interesting to see the probabilities.
Think of this simulation as trading right before the crash in low implied volatility, through an IV spike, and then high IV period that followed. Okay, so low IV, and you have small positions, low IV, trade through the IV spike, ramp up the positions, and then a sustained period of high implied volatility that follows. Let's go to the next slide. Below are the actual statistics of the short SPY 16 Delta Strangle performance between 2007 and 2009. These results will now be used as inputs to the Monte Carlo simulation. So we did, as we said, basically, if you're short a SPY 16 Delta Strangle, sold 45 days out and rolled at 21 days, your win rate was cool. Even through that whole period, 75%. The average loss, excluding the worst 5%, was 0.4 of the credit. Okay. The average win was 0.5 of the credit. But the worst loss, which happened 5% of the times, was 4 times the credit. So you win 75% of the time, and your credit, that your loss is actually even less than your credit. So that was totally fine. It's just those outliers that came back 4x that would actually, bite you bad in the butt. Let's go next slide. So before we get to the results of the simulation, it's important to know how to interpret the upcoming statistics. Since we are simulating a highly unlikely scenario where the vast majority of tail risk happens, it's important to interpret the statistics on a relative basis. In other words, a single statistic on its own carries little value, since the context of a single statistics will be a trial of 1,000 portfolios, which would never apply to an individual.
Yes, it's true that obviously will never apply to an individual, but it's always good to have an idea of, for example, a portfolio where it's like 20% allocated only for short strangles, how it would have behaved during a time like 2008 or 2020, where you had the SPY losing like 35% in the span of a couple of weeks. I mean, remember that time? That's crazy. And I think that's super, super valuable that they are actually providing this type of studies, because for the average investors, we do not necessarily have the means of building our own backtest because it's so expensive to buy all of the options data. So that still gives a pretty good picture of how would your portfolio behave during a crash like 2020.
All right, all this makes sense to tastiers.
So far, yes.
Yes. So let's go to the next slide where we start to get into the details of it. So we saw that overall, the probability of a 50% portfolio drawdown in a 2008 style market is quite high and usually unavoidable regardless of the total buying power allocation. However, we find that increasing your average portfolio usage from 20 to 30% essentially doubled the probability of extreme drawdown, in this case, an 80% drawdown.
So that's quite crazy to see those numbers. Basically, if you have been allocating like around 20%, you've been only selling short strangles on the SPY during an event like, for example, in 2008, you would have like a 74% chance of actually seeing a drawdown of 50% on your account. And something that is really, really important to consider here is that obviously when we look at the numbers, we're like, oh my God, so, you know, it's crazy. Options are super risky. However, I tend to argue that who didn't have a 50% drawdown in their portfolio, even if when they are long stock. I mean, even if you were long stock, for example, in 2008 type of event, well, you would also have a huge drawdown on your portfolio. I mean, that was just the overall market. That was just everything was going down. It's not just options that are at fault here. It's really the whole market. So obviously I'm biased because I'm going to prefer to trade options and I'm not really objective maybe here, but you know, it's important to understand that even though, yes, it's true that you would be in a drawdown of, let's say, 50%, you have a 74% chance of being in a 50% drawdown. Well, you know, someone who would be long stock would also be in a 50% drawdown. It's important to note that.
This only assumes that you managed at 21 days and you didn't take any action in between. So there was no delta adjustment or any of that kind of stuff in here, right? But when you look at the Monte Carlo simulation that we put together, we only did 20 and 30%. But when you look at it, you can see the probability of a portfolio drawdown with a 20% allocation is a fraction of what it is with a 30% allocation. And so we just put the number, you know, it's basically double by just going up 10%. Now, again, there's no adjustments for delta here. There's no hedges. There's nothing except managing at 21 days.
If we talk about delta adjustments, meaning, for example, like rolling your calls down when the puts are in a loss, I mean, it's not going to do much, unfortunately. You know, like the credit that we're going to receive, even if we roll the calls down, are not going to be enough so as to cover like the huge, massive loss that we would have had on the put side. So, you know, and when he talks about hedges, I mean, you know, very few people are actually, for example, buying SPY puts, for example, around the 5 delta in case of a crash. Very, very few people are doing it. So that just also shows the importance of trading small in general. And here, obviously, as I mentioned, they are only trading short strangles, and who is just only trading short strangles? I'd be curious to know if some of you who are watching this are actually only trading short strangles, because I don't really see anyone just trading short strangles and allocating like 20%, 30% of their portfolio only doing this. But, you know, that's fair. At least that gives a good view of the worst case scenario. And that also shows that you need to trade small when we are in low implied volatility environments.
This is not the way we trade. Because we make tons of delta adjustments, we try to keep everything in line. We're very careful and very meticulous about, you know, about managing our portfolio and doing things to the process and maintaining, you know, a certain delta risk. This is when delta got out of control. But we felt the raw numbers were pretty valuable. So you look at the difference between a 20 and 30% allocation, it's pretty damn impressive.
Sure.
And that's a tiny allocation. But again, most people would have allocated more, but you know what? You don't really, like, when you see a big sell-off, the first thing you want to do is sell premium into strength.
Exactly. Right. And then, strength of the volatility.
At some point, it gets a little scary, like 2020 or like 2008 did.
Yeah, that's always the thing. Like, you know, it's very, very easy to say that we're going to sell premium into strength, meaning that as premiums are getting more expensive, you want to take advantage of this, but obviously you don't want to catch a falling knife. So it's always extremely hard during a very quick movement down that you want to sell some puts. It sounds simple on paper, like, you know, you're going to sell puts when premiums get more expensive, but in reality, it can get extremely stressful and you just don't know how low the market is going to go. So you don't want to catch a falling knife, obviously.
At that point,
we're on a 10% move in volatility right now, sure. Or 2% move in the NASDAQ on top of.
Yeah, and then you're aggressively addressing positions from that point on. I mean, that's essentially how, you know, that's essentially how we operate. Let's go to the next slide. So the risk of getting big. So the simulation that shows that experiencing 50% portfolio drawdown will be nearly unavoidable for those investors taking on average stock market risk. Now, again, the stock market drew down in both cases, in 2020 by over 35%, and in 2008 by almost 70%. So the 50% drawdown is not that much different than what you would experience if you were doing something and just have a basic long portfolio, right?
Yeah, that's exactly what I said. Obviously, you need to obviously compare that to, for example, someone who would hold the SPY and, see how the drawdown is actually being compared to that. Because obviously, if you just look at the drawdown in options, it's easy to say like, yeah, but the options are risky, except that someone who would have a long portfolio, who would be long SPY or SPX, whatever, well, they would have the same thing, if not worse. So, it's about trying to see what is the least risky, and during normal times, like who is making the best money, the best returns. So obviously we need to compare apples to apples here.
Right? Mm-hmm. Mm-hmm. So the key is to show the drastic difference in probability of extreme large drawdowns when you when you allocate slightly less when trading options. A decrease in portfolio buying power reduction allocation from 30 to 20% reduced the probability of an 80% drawdown by 50% or by half.
That's still a significant drawdown, right?
We are still really just stressing the importance of
watch your size, be smart. It's a long haul, it's a long game.
We are always here to play this game, and
decades.
We will always be here to play this game. We're never changing that. Let's go to the next slide. Here are the takeaways. When trading options, it's crucial to understand the risk you carry when selling premium. Over allocating an option portfolio is a non-issue 80 to 90% of the time, but a critical issue during market panics. The goal of a successful option trader is to stay in business. The variable that will most likely affect this is portfolio exposure in dull markets leading up to a crash. One of the things that we learned from a piece of research we did the other day was that the market, when volatility expands and the markets are oversold and you get these crazy periods of volatility, it is very hard to over allocate at that point. Because at that point, you usually have significantly less volatility risk than you have when volatility is low and the markets are dead and complacent.
Yeah, that's for sure. That's something that sounds extremely counterintuitive. But for example, after the crash of 2020, when we were around May, June, July, and everything that basically followed the COVID crash, is that it's not risky after actually the crash, as counterintuitive as it sounds. It's when the markets are being complacent, when there is very low implied volatility, and just the market is just grinding up, that's actually where is the riskiest time. It's when nothing happens that it's actually the riskiest to trade. When you see that the VIX is around 12 or 13, for example, that's really where you need to be careful about your size. And personally, I'll never exceed, for example, 20-25% of my buying power allocated if we see, for example, the VIX around between 15 or between 10 and 20. I'm really going to be careful. But after a crash or after a big down move, you can be pretty sure, for example, after the crash of 2020, then almost nothing is going to happen at that point. It's when nothing happens, as I said, that is really the riskiest to trade. I hope that was insightful, and that shows a bit the risk of getting big and why you really need to keep your buying power allocation quite small. And personally, I'll always keep it around 20% if we are, for example, in a low IV environment, and then ramp that up if we see that we have more volatility, and especially after a crash like the one in 2020, for example. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.